Hello, everyone. Today I am joined by Filip Surowiak-Long, who is head of crypto sales at Paysafe, and we're here to discuss a very interesting topic that has come up several times on the podcast before, which is payments, specifically high-risk payments. Filip, welcome. Filip, could you briefly introduce yourself? Tell us a little bit about who you are and what you do.
Of course, let me do that. So my name is Filip. I'm working with crypto at Paysafe. So let me just tell you a little bit about sort of how I got here. So I ended up I started my career in a little consultancy called BCG, and then sort of navigated from there into payments. Did a little stunt in startups, sold one of them to a big PSP called Paysafe, and now I'm here.
That's a fascinating story, and I want to dig into the details of the startup that you sold. But first, I think it would be useful to take a little bit of a step back and talk about payments and the payments business in general, specifically high-risk payments. So, Filip, what do we need to know about the world of payments and how payments operate?
Of course. So let's maybe talk a little bit about sort of high-risk payments, because it sounded like that was kind of what was sparking the interest here. So high-risk payments are defined as sort of payments that are prone to fraud, to chargebacks, and non-compliance. There's particular industries or sort of areas that would be seen as high risk. So that would be certain industries. So crypto that I work with here at Paysafe. We also have many sort of other industries like gambling, entertainment, where they're prone to sort of fraud and chargebacks. But merchants that have sort of historically have had a lot of high sort of risk and fraud would also sort of fall into that bucket.
So these payments are then primarily defined. So it's defined as high risk by whom? By card issuer, by the industry in general. So who exactly gets to define what high risk payment is?
Of course. So there is. It's kind of a mix of the two, right? So it's when we in the sort of payment space sort of take on new merchants, we would by default sort of certain verticals, certain industries, for example, would be seen as higher risk, right? So gambling, entertainment, adult entertainment, crypto by default would usually be seen as higher risk, because it falls into some of these buckets of fraud, chargebacks, and non-compliance. Some geographies would be seen as higher risk because, again, they would often have some of these challenges. And there's also sort of other characteristics like volume or cross-border transactions and so on.
Okay. So these high-risk payments, my understanding is that a lot of sort of day-to-day businesses don't necessarily want to deal with them, particularly for the reasons that you mentioned, right? There's high levels of fraud, there's high levels of chargebacks, there's all sorts of situations going on which make it difficult for normal payments businesses to deal with. So these get sourced out to specialized high-risk payments providers. Is that correct?
Correct. So there's definitely sort of players in the market, so sort of payment providers in the market that would specialize and focus more on the sort of high-risk verticals, while others would prefer to operate in verticals with sort of more sort of lower risk merchants. It's a completely different skill set for completely different compliance requirements, onboarding, and so on, that have to be sort of taken into play.
So how can some companies specialize in this industry in high risk? What is it that they do better or that they do different compared to your standard payments business that can serve these customers better?
So it's a mix. It would be a mix of sort of skill sets. So one would be just the sort of compliance, going through and reviewing merchants before they get onboarded, and so we're sort of looking at making sure they look at the right things. I would, just to give you an example, to onboard an e-commerce business, if someone, in COVID, a lot of people set up little home businesses, online businesses, and to set something like that up with a payment provider could take you, a couple of hours, maybe half an hour even. To set up a high risk sort of payment rails would take you weeks, if not months, right? Because of the reviews and all of that has to be done up front. The number of information that is shared about that merchant, about its UBOs, about where it comes from, about licenses that they hold, is a lot more ownerable than it would be for an e-commerce business, for example.
Right.
That's one. I think compliance is one example. Products are another example. So alternative payment methods are a lot more common in high-risk verticals than they would be in for example, e-commerce or some lower-risk verticals.
So by alternative payment methods, you mean everything that is not standard credit card transactions online, right?
Spot on, exactly. So they're starting to be called local payment methods because in most cases they're actually local and they're sort of country specific. But of course there are some that are a bit more international as well. Okay,
and just so that we can circle back a little bit on the actual end users of these services. So there are merchants who are either in a complex geography like you mentioned, or are in some sort of more complex industry where there are high rates of fraud and chargebacks, etc. Can you talk a little bit about why these merchants face these issues more than your standard day-to-day e-commerce business?
Of course. So why do they face these issues? It comes down to the sort of ease of frauds happening in these areas, right? So just by the fact transactions are larger, right? If someone is buying crypto, they're probably not going to buy it for $10. They're probably going to put in a couple of hundred or a couple of thousand dollars into the transaction. So it's a fun transaction where it's a much larger likelihood of fraudsters trying to come in and navigate this space. For smaller transactions in e-commerce or in other industries where it's maybe a physical good, it's a slightly different this sort of slightly different mechanics that fraudsters can use. I think it's usually that's where it sort of comes down to. It's chargebacks are another one, obviously, because if fraudsters come in, the chargebacks grow because they're essentially that's one of the methods that fraudsters would use to try to navigate this space. So they're trying to sort of use chargebacks and claim that the transactions weren't successful, and then try to claim back large volumes. So essentially, the more of these sort of fraudulent events happening, that kind of creates the vertical to be more high risk, and that's why all the payment providers involved in this space start charging higher fees, because there is the typical high fee, high reward obviously comes in, and if you have these risks, you want to be sort of rewarded for them.
Okay, so from what I understand, then it's not necessarily the case that the businesses themselves are in any way higher risk, but rather the fact that there are fraudsters out there who might want to exploit these businesses and try to use them for their own ends, right? So if I'm a fraudster and I buy a bunch of credit card details off some dodgy online market, I would try to use a crypto exchange or some other sort of online business to try to cash them out. And instead of, I don't know, spending it all on e-commerce websites, buying things for $50, I want to do these big, large transactions on a crypto exchange to try to get away with the money. Is that correct?
So I think it's broadly correct. Of course, there has been cases of fraudulent players in these sort of industries as well. So in gambling, in crypto, and so on, there is definitely those industries have been more prone to sort of being a bit more gray zone and not always following the rules as compared to sort of low risk industries. But it's also a misconception that all high risk verticals, that all the merchants in those high risk verticals are fraudulent and troublemakers.
One thing that you mentioned was chargebacks. For people that might not know, can you tell us first what a chargeback is? And second, how does that impact the different players in this ecosystem, the consumer itself, the merchant, but also the payment services?
Of course. So when you look at chargebacks, so just very simplistically, I think chargebacks are a way where for some reason, for one or one other reason, the individual, the buyer of the product has either not received the product that they were meant to receive. The product was in any way different, or something was wrong with it. But also it could be obviously fraud in some of these cases. So in those cases, what happens is that the sort of user issues a chargeback, essentially says that I want to get my money back. It's different to a return. So if you think of e-commerce, it's a slightly different process, but it's can be sort of confused. But it's one where the customer essentially goes back to their issuing bank and says, "Look, I need to get my money back. There's a problem with the purchase that I've made." What then happens is that the issuing bank gets in touch with the merchant through the acquiring bank, the one that sort of took the payment, and tries to get the funds back for the user. Of course, there's then a process in place where the merchant can either push back on that transaction or on that information that has been provided by the buyer, or if they have enough sort of good information. And that's also sort of the sort of mechanics of how you can protect yourself versus chargebacks. So if you do have sort of very good information about all the services that you're providing, and you collect all these data and have all the right systems in place, you can protect yourself versus chargeback. Obviously, having a good sort of support team and so on would always help as well. There's other sort of ways from a fraud perspective that can also be used. So implementing CVVs or address verification, and there's a lot of other sort of things that can be done that would help a merchant to protect itself versus chargebacks.
Just to take a step back, if I understand correctly, you have on one hand the consumer and the merchant. The merchant sells any service, so this doesn't necessarily mean high-risk businesses, any merchant.
Yeah.
And then you've got the merchant's payment service provider, and then two banks. One bank on the side of the merchant, and one bank on the side of the consumer, right? And then you've got the scheme, which is Visa, MasterCard, etc. So the merchant charges the customer's card, and if there is a dispute, first it goes through a process where the two banks get involved and they try to figure out, okay, like, should we actually pay the merchant or should we give the money back to the user? And eventually, if there is a significant amount of these disputes, and for some reason it seems like the merchant is not entirely above board, either they don't have the necessary protections in place, or they're actually a malicious actor, then the schemes can actually get involved and say, okay, we're going to fine payment service provider and we're going to kick this merchant off the platform. Is that how it works?
Spot on, exactly. You've explained it very well.
Okay, well, I'm trying to understand how it works. Okay, and to what extent does it actually come down to fines versus to what extent does it actually come to payment services providers and banks trying to avoid having these problems with Visa and MasterCard? To what extent is it self-policed versus actually policed by the schemes?
It should be more the latter if they're doing it the right way, right? So in our case, for example, we would police ourselves and make sure that we would look at all of these cases on a regular basis, and we would try to give merchants a bit of a slap on the wrist and make sure that they try to almost help them as much as we can to improve their processes and kind of let them know when they're doing something over that they shouldn't be doing. The worst case is when Visa and MasterCard tells you about something you didn't know about, right? Because then it's almost too late. You have to turn the merchant off. And if this happens too often, you might even end up losing your license with Visa and MasterCard, and then your kind of whole business is struggling. I think it sort of depends on every player is kind of doing this in slightly different ways. So you have the larger PSPs that are obviously very conscious of their license and making sure they stay in business and are allowed to do business and do more business. And so that's why we have sort of big compliance teams and people looking at this on a regular basis, monitoring and onboarding only the right merchants. So out of 100% of merchants that come to us, we would onboard only a fraction or so of those, especially in the sort of high risk verticals. But also, yeah.
So if I understand correctly, the main concern has to do with compliance with regards to the card, so the schemes, the Visa, MasterCard rules. The main worry is fraud and chargebacks, less so than necessarily the whole AML and anti-terrorist financing concerns that perhaps you would see in other financial services.
But both are concerns, right? So I think both are something that we look at when onboarding and monitoring. So obviously both are very important. When you look at high risk, it would be a bit of both, but the higher fees and the higher fees essentially come mostly from the higher costs, which are coming from chargebacks and fraud protection. But when, just to give you a couple of examples, when we onboard merchants, we look at the MLRO, we look at their CV, looking at, what experience do they have in AML, and making sure that they are the right people at the right spot because they are going to be the person essentially protecting that merchant from AML, from sort of making sure they do the right thing from an AML perspective and fraud protection and sort of that sort of perspective.
So we hear a lot about this epidemic of fraud online. It comes up quite a lot. I think anyone that has ever worked at a fintech company is very much aware of the fact that fraudsters are very much out there and trying to get you. Is this something that you guys have also seen out there? Is it really such a cat and mouse game with these organized fraudsters who are trying to chase every opportunity to make money?
Yes, 100%. So you definitely see fraudsters kind of working in groups and attacking certain verticals, certain merchants and payments providers. And then they sort of keep on moving on and moving on to other sort of areas. They sort of attack. When they attack quite hard and sort of specific areas. It can be a certain payment method, or it can be a certain geography, or anything else. But you definitely see them. My sort of compliance team often tells me that they've, that sort of this type of fraud is not going around in this area, and be careful with what you're doing. And
what are there what trends would you say have been going on globally in the high risk payments industry? Is there any sort of geographic changes that have been going on? Have there been regulatory changes that you guys have had to adapt to? What are the kind of underlying themes?
I think the sort of local payment methods, alternative payment methods, have definitely become a lot more popular across different markets. So just to give you a few examples, Blick in Poland is now accounting for more than 50% of all transactions. Ideal in Poland, Software to Europay in Germany. They're becoming more, not only across high risk, but across the board, becoming more popular than card payments or bank transfers very often, because it's often becoming a sort of preference by the users, and it's just the mechanics of those payments are very different from everything we've discussed already. Legislation and licensing of some of these high risk payment high risk verticals. So crypto is probably the best example. So crypto legislation has moved on massively since the beginning. We're currently in Europe, for example, cryptos currently have VASP licenses. While that's now going to be changing with the MiCA regulation coming out, and VASP licenses haven't actually even been around for so long. So it's a kind of ever evolving game in this sort of space.
So let's dig into the alternative payments a little bit more. So they're increasingly popular. You mentioned a few. what are they exactly? Are they sort of API-enabled bank-to-bank transactions, or how should we think?
That's a good way to sort of start looking at them. There's a lot of other aspects that make them interesting. I think the sort of user experience of them, a lot of users, they become a lot more local as well, right? Because a lot of them you feel like you're paying with something that is from your country, that is local. Ideal is, just in Holland. Blik is just in Poland. That I think that's one aspect. I think acceptance rates tend to be a lot higher for high risk verticals through those payment methods.
What do you mean by acceptance rates?
So proportion of transactions that get accepted. So if a user tries to do a transaction and what proportion of those transactions actually get accepted. So for some high risk verticals, that acceptance rate can be as low as 50-40%, depending on, what you're looking at for card transactions. While for alternative payment methods or local payment methods, that can be a lot higher than that, which is one big benefit. Chargebacks, so chargebacks is something that only exists for card payments. You do have an equivalent sort of process for alternative payment methods as well. But historically, we've had less of those. This seems to be harder to do chargebacks on local payment methods. It obviously depends on which one we're looking at. Pricing can sometimes be it's different. If you look at underlying cost, it's a bank transaction. It's a bank transfer transaction. So it should, in theory, be lower because you have less parties involved than you do for a card transaction. We went through earlier sort of how many parties there are involved in a card transaction. There's quite a few of them. There's less parties involved in local payment methods.
Okay, I see. So there's numerous advantages for both the consumer and for the merchant. For the consumer, the advantage is that your card payment, or not card payment, your payment will probably get through and you'll get whatever you want to buy from the merchant. From the merchant's perspective, it means that they deal with significantly lower chargeback risk or the equivalent, whatever it's called. And also, they also want to get paid, right? So it's all around seemingly a little bit more of a successful payment method. But I guess the struggle for the merchant then means, well, if you're an international business, that means you have to set up different platform and API in Poland versus in Germany versus in the Netherlands, right? Which is where you guys can help.
100%. So we specialize in aggregating payment methods, right? So Paysafe owns some of the payment methods themselves, but we also aggregate payment methods. So sort of through one integration, you can get access to over 100 different payment methods. And so that's 100% where businesses like ours can come in. So if you are an international player and you're looking to feel local in many of these markets, that's one way to do it. But if you are a local player, you can kind of directly go to your local payment method.
What are some of these international payments methods that Paysafe owns that are used by merchants to get access to a wider range of customers?
Of course. So we have a few wallets that you can that's high risk verticals, and we also have eCash. So when it comes to the wallets, the way it works, so not all of the local payment methods would want to work with high risk industries because they kind of see the same risks that card transactions would see. But they would work with someone like a wallet, like a Skrill or a Neteller, which are two Paysafe wallets, where they integrate into Skrill and Neteller. And then the user essentially first deposits the funds into a wallet and then moves those funds from the wallet to wherever they want to send the funds to. The second one is the eCash business, which is also very international. So we own about 1 million different locations internationally. When I say locations, these are sort of convenience stores or sort of fuel stations or anywhere that's sort of convenient for the user to go and deposit some funds into one of these merchants. They do that by essentially first getting a barcode digitally or purchasing one of these barcodes in the shop, and then essentially funding the merchant account.
Okay, I really want to talk with you about the eCash method because I know that your startup was around that. But first, let's take a step back and let's talk about these wallets and how exactly they work. So effectively, what you've got is the user who makes a card transaction or a bank transfer or whatever other method to the wallet. The wallet now has the money and it's an extra hop to whatever merchant that they want to transact with, right? And then the advantage for the payment services provider is that you're not necessarily directly transacting with the merchant, but rather that layer happens from the wallet itself, right?
Correct. And we do all of the KYC on the user because the user essentially first has to create this wallet and then they fund this wallet. There's over 100 different payment methods. So depending on which country you're in, you get access to you see the payment methods that are relevant to you. The user is essentially creating an e-money wallet, which is the same regulation that Revolut used to be under until they sort of got their banking license just recently.
Very recently,
and many of the other sort of challenger banks in the UK and across Europe as well, right? So it's the same type of wallet that we're using, but we're also then sort of having an integration into many of these merchant accounts. The user experience feels similar to PayPal. So anyone that sort of used PayPal before, you essentially kind of create first a PayPal account. And then within PayPal, you have access to other payment methods. In PayPal, though, it's always just card payment methods. So you only have access to so you can add a few different cards into your PayPal account. While with Skrill or Neteller, you would have access to several other different payment methods that Payzip has aggregated.
Okay, and if I pay someone via this wallet and I end up having a dispute as a customer, do I have any recourse? Can I talk to someone and say, hey, I paid this merchant, but actually I never got the item?
Yes, 100%. So Skrill in this case is very much involved in this space as well, right? So it will be the issuer of the transaction, and what Skrill is really good at is that because Skrill is part of the sort of big Paysafe brand, we're very used to high risk verticals, and we have all the sort of counter rules in place to make sure that happens as seldom as possible. So that's the sort of first protection. What we also do for merchants is that we allow them to opt in to what we call chargeback protection. And so we charge them a flat fee for every chargeback that's requested, but we manage the full process and we manage even the funds that potentially have to be given back to the user if the chargeback is successful.
Okay, so this is very interesting. I want to quiz you around eCash and your startup, but first, I kind of wonder on a philosophical level, like why does this whole industry even exist? Is it just basically a case of legacy tech being ported down right from the 1950s or 60s, whenever credit cards were invented? It was a very offline world with not nearly as much online fraud. And fast forward to 2024, there's all sorts of very sophisticated fraudsters out there basically trying to exploit technology that has been patched up to service the online world. Is that the case? Is it the case that it's just basically technology, a payments technology that is kind of antiquated and not suited to the online high fraud world, and high risk payments basically comes in to cover a subset of the market which is just not suited to? Would you say that that's the reason why it exists?
I think it's a much larger topic, and I think it's a really interesting topic. But I think fraudsters and fraud has probably existed from the beginning, of humanity, right? And yes, I think going online with this has made a difference. And yeah, maybe card payments have been around for a long time, right? And is like even if you look geographically, right? I think cards are if the main card issuers is Visa and Mastercard, right? They're both US businesses. If you look at what's going on in China, right? They pretty much all transactions are done through Alipay and WeChat Pay, right? If you don't have Alipay and WeChat Pay, you won't be able to pay for anything on this when you go to China, right? And I think a lot of these sort of European markets are kind of going towards that model as well. So they're pretty much bank transfers that have been nicely bundled in, making them potentially more efficient and easier. And I think sort of, what is the next step to that, right? Maybe blockchains, right? I think that's the reason with crypto coming in and making it a lot clearer of, it's everything that's on the blockchain stays there forever and it's tracked and theoretically, if used in the right way in the future, that would be the single source of truth, right? And I think we're probably going the right direction with this, but it's just, I think with technology, you always end up with having some technology that's still antiquated. You have some technology that's really cool and modern, but it takes time for users to adopt and sort of go the full way.
Yeah, these alternative or localized payment methods have really been such a booming story. Partly also in Europe, but the stories I've heard are primarily around Brazil and Pix, which has been a huge success as far as I can tell. And also, I'm Costa Rican, so I spend a good amount of time in Costa Rica. There's also a local equivalent there that, every fruit seller on the side of the road will have their local account where you can literally just text, like you can transfer money to a phone number.
You're breaking it.
Oh, can you hear me? Sorry.
No, I can hear you.
Okay, so what I was saying is these localized payment methods, you mentioned, I think for the fintech reader from the past, they were primarily known to exist in China and in some marginal European countries. I know that Ideal existed forever in the Netherlands. But in the last few years, they have really picked up pace in a lot of other places. In Brazil, Pix has become a phenomenal success. And even in Costa Rica, where I'm from, even the fruit seller at the side of the road will have a local equivalent and they can get paid with via bank-to-bank transfer that's linked directly to their phone. So what are the sort of regional trends that you're seeing apart from that? Are there any particular regions that you feel are ahead of others or where, this high-risk segment is a little bit broader than anywhere else?
Yeah, no, I think so. I kind of feel that the US is staying with cards because that's such a sort of native way of paying. Both Visa and MasterCard are both American, right?
Yeah.
I think 100%, right? LATAM is another really good example with Pix, with several other sort of local payment methods across different markets. Asia, Africa was leapfrogging cards and and Pensa has been around for a long time now and paying with instead of even creating bank accounts, you had your mobile account and you could sort of essentially pay from your mobile phone, but not from a bank account, right? Just from your sort of mobile, from your sort of monthly mobile subscription, right? So I think every market a lot of markets are sort of going towards these, sort of following these trends. I think it's definitely interesting to sort of see where this is going to sort of end up, where it's going to sort of take us. It's super interesting for companies like ours because we sort of aggregate and it makes us even more interesting to merchants, right? When they're looking at who to pick, because we are sort of putting it all together. But I think it's kind of becoming more local in the same way as also becoming more international.
Philip, I really want to ask you about your experience with eCash because you had a startup that you ended up selling. Tell me first about the original inspiration to even start an eCash business, because I think most people don't even know what it is. Why did you think of starting one?
Yeah, no, 100%. So I actually I was part of the sort of management team. I didn't actually start it from day zero, but I joined two entrepreneurs from Germany that had started the business as sort of like a university like as a university project, right? They came up with an idea, they started there, and then they sort of felt, why don't we start a business out of this? And they went ahead, and we're starting to get some traction in Germany, where cash is still very heavy across different markets. And what they did next was that they essentially decided to reach out to start expanding across Europe, right? So they hired a couple of us to help them expand across all of Europe, because they saw sort of similar trends across different European markets. I think there was a couple of early interesting things that we saw in the market. So I think it's sort of coming from, at that point I had already launched 2 challenger prepaid card solutions, more from the sort of payment side and sort of marketing side of those, and sort of almost going, back into a cash world, which kind of felt, in some way kind of felt, antiquated, but it also, the way they were sort of talking about it and the way they were looking at it felt very exciting, right? Because what we discovered early on was that, yes, the sort of underlying cash usage across the sort of Western world, Europe, is potentially declining towards the use of cards, alternative payment methods, and so on. But the supply of cash was declining even quicker. So when I say supply of cash, I mean bank branches,
physical
right?
banknotes.
Physical bank branches, physical ATMs. They are sort of disappearing from the high streets even quicker than the sort of the amount of banknotes in circulation is actually fairly flat, or has actually even been increasing in some countries, which is also interesting, even though usage is declining. So I think that sort of mismatch was what made it really interesting, because we could, what we did see was that there is still demand for cash. There is still users that like to use cash because, for example, budgeting, right? It's a lot easier to budget when you've, you made your salary, you've paid your rent, you've paid your sort of utilities, and then you have a couple of $100 left in your account. It's easier to keep it in your pocket and know exactly how much you have left to spend than sometimes have it in a bank account. Older users are often like to use cash. And for that reason, often millennials or sort of younger users also end up having cash, because they get money from their grandparents, or they get money for other reasons. They get sort of their income or their sort of funds from their parents, often if only cash as well, while they want to be spending digitally, right? They want to be buying products online. They want to be taking Ubers. They want to be sort of spending funds digitally.
Is that what the main eCash user journey looks like? Like, I have physical cash, but I want to be able to spend online. Is that what it looks like?
A lot of it, yes, because what we did think initially was that we're going to have more withdrawals than deposits, because if you think of, cash, you think of, where's the closest ATM? How do I get cash out? But if you think of how do I then put that money back into the system, there isn't that many places you could do that. So there isn't, you can't do that in most ATMs. So in some countries, yes, but it's not that common. You can, in most cases, it has to be a bank branch, or in some countries, it can be a post office. What we created was that we now have, over 1 million locations across Europe, North America, and Latin America, where the user can literally go into a grocery store with a barcode and put that cash directly into their bank account, the Challenger bank account, or buy something online as well.
So there's users that have cash and want to be able to interact with the digital world. So right now, the way the system works is I, as a user, can go to a grocery store or to some other retail point, deposit cash, and either have it in my bank account or immediately interact with the merchant and buy some, Uber credit or things like that.
100%. It's a bit like a digital gift card in some of these ways, right? You sort of the same people that would go into a supermarket and buy a physical gift card can now also do that in a more digital way through some of these solutions. Or, as you said, right, it's funding a bank account or a challenger bank account. So, Revolut, we're working with them, N26 in Germany, Bunk in Holland. They're all non-traditional neobanks, right? They don't have branches. But what they've realized was that very quickly some of these physicalities of having a bank branch are still sort of something that the users want to have access to. And one of those was cash.
Okay. So can you tell me a little bit more about the users themselves? Like what do you mentioned that some of them are older, some of them are perhaps not used to manipulating digital products. You must have done some research while working at this. Who are these people, and why are they so underserved by the current?
Yeah, no, 100%. So I think that sort of underbanked space we've done a lot of research on when we're still when we're focusing on the eCash side of things. So there is, even in places like the UK, there was millions and millions of users that have been underserved or underbanked by the banking system, right? In many of these cases, it might be foreigners, or it might be people that are more sort of manual workers, and where they often get paid the chunk of their money in cash, right? So, outside of big cities like London or so on, right? In other parts of the UK, for example, taxi drivers would most of the time still take cash. A chunk of what builders get probably still is in cash. Tips that are given in the sort of food sector and sort of restaurant space is often still in cash. In SMEs, many sort of smaller shops, still very much cash, right? And there is still a very large sort of part of the population that still operates in that sort of world.
I see, I get it. And before, maybe like 20 years ago, I would have gone to my local bank branch and deposited some cash there. Now that bank branch is closed, so I don't have that option anymore. So instead, I'm going to go to an eCash service provider. Okay, and what does the business model look like from the perspective of the provider? Like, you get cash, the cash is now sat at some grocery store. And that cash has to get to the customer's bank account. First of all, how does the eCash company make money? Secondly, what do the logistics of that look? Because it sounds pretty complicated to manage cash inventory all over the world in hundreds of different countries.
Yeah, no, 100%. So I would say it's let's start even a step earlier than that, right? It's very much, when we started this whole business, it started in Germany, and then we sort of went market by market. It was very much of a chicken and egg problem, right? Mm-hmm. We first needed to have the network before we could even sell it to any merchants, right? And many of these merchants are fairly local, because they were local challenger banks, or they were, utility providers or whatever that wanted to have the service, but we needed first to go to the retailers with the promise that, these are the sort of merchants we will be able to bring through the door, right? So what is the business model? We've inverted the business model slightly. So you might have heard of cashback. So cashback is still around very much across Europe and other places in the world, where a user can go into a grocery store and get some cash out. Cash out, right, from their card. So in our model,
the cashback is useful to the merchant, to the grocery store, etc., because then they don't need to have like a physical money truck show up and take the money to the bank, etc.
Exactly, they get rid of some of the money. The schemes are actually charging the retailer for those cashbacks. What we actually started doing is that we started paying the retailer, right? So we were paying the retailer a smaller fee, but we were not charging them; we were paying them, right, for the withdrawals. What we also started doing is that we So the way the model works, so we started going, so with the merchants, we essentially negotiated a fee for every single deposit and every single withdrawal. And then we were essentially sharing some of that with the retailers, right? So with cashback, they were getting charged, but we were actually going and paying them, right? So we were paying them substantially more for a deposit, because in that case they were left with the cash and they had to then get rid of that cash. And for withdrawal, we were paying them a little bit less, but they were still kind of providing a service for us, and there was still sort of, you know, one additional person in the store that was buying that was coming in. The additional sort of benefit they were getting is that additional customer, we've done some research that on average, 50% of the users were actually also then buying something in that grocery store. So the retailer would essentially, you know, they're increasing revenue from the additional customers we're bringing to their stores. So that, in a nutshell, that's how the model worked. So you were essentially charging the merchants, sharing some of that with the retailer, and essentially keeping the rest.
And how do you manage, as a platform, the AML risks that entails? Because I'm sure that there's regulators out there looking at that and thinking, oh, wow, like this is all of a sudden potentially something that's quite risky.
Yeah, 100%. So what we were doing is that, to give you an example of the challenger banks, right? So to do one of these transactions for a challenger bank, the user essentially had to, first of all, have a challenger bank account. So, right, they were all AML KYC users, right? So we have all that information about who is this user doing this deposit or withdrawal. Then the user, essentially what they had to do is that they had to log into their challenger bank account and choose to do a cash deposit or withdrawal. So we knew usually in most of these cases, they were doing a biometric login. So we knew that, first of all, they're KYC. Second of all, we know they've literally just done it. We know it's them because they've literally just logged into their account, and then they're creating a barcode that they're showing to the at the retail store. The barcodes were getting being changed every few seconds, so we know it's them. They can't share it with anyone. So it's almost, even though it's very simple and it's cash and it's digitizing cash, it was very protective, right? Because we had the full information about who the user is and them there at the spot in time. So from a sort of chargeback perspective and so on, very few of those, because we had all of this information about what's going on in the transaction.
Yeah, and I guess if someone starts depositing suspicious amounts of money, suspicious amounts of times, then obviously that rings alarm bells with you guys, but also with the bank that they're servicing, right? Because it's functionally the equivalent to showing up to a bank account and depositing money several times a day.
No, 100%, right? So we were, there's obviously some limits. So we had some very strict limits on how much was being allowed to be deposited or withdrawn. There was limits on a daily basis, monthly, annual basis. And obviously if the limits were reached or they were getting close to those limits, then the user had to provide some additional, where are those funds coming from, but again, that process is quite a standard process that most banks or challenger banks would have anyway, right? I think what we were also doing is that in most cases, even if every single challenger bank had a bank branch, they were only looking at their own ecosystem, right? What we were doing is that we were looking at all of the challenger banks that were on our process, and we could see, oh, look, the same user is now walking around. He has 5 challenger bank accounts, right? And he's like, what we're trying to do then, exactly, right? So we could see from a regulatory point of view, they actually quite liked working, or they quite liked what we did, because we kind of create that cash ecosystem where we had very good data on what was going on in the market, and could very quickly spot fraudsters or see what's if someone is trying to do anything out of the order.
Filip, what do you think are some of the biggest misconceptions around either eCash or alternative payments or just high-risk payments in general? What are the things that people often get?
I think they often get wrong that it's all high risk is dodgy or is sort of gray zone, is trying to on purpose do anything wrong. I think the misconception with cash as well is that all cash is there for a sort of illegal reason or anything like that. What we've seen is, I've been in those two industries for some time, and it's the big majority, 99% or 99.999% of all transactions are valid, rightful transactions. And there is, a small percentage of users that are trying to sort of mess it up for everyone else, right? I think that's quite common across many industries, right? That's definitely one. I would say that's probably one of the biggest misconceptions.
Do you think that, we're moving into a world where cash transactions are increasingly more rare? Do you think there's a danger that we effectively shut out certain segments from?
Yes. So I would say that they are becoming more rare. And if you look around the high street, less and less merchants are accepting cash because of there is a risk of taking cash. There is you need to get rid of the cash in some way. If you are a petrol station that is in the middle of nowhere, there is a bigger risk of robberies and all of these things, right? So we definitely see that that's where a lot of the merchants are going. But at the same time, there is also a risk that some segments of the market, of the users, are going to be left behind. So older users or unbanked and so on. There is markets out there. If you look at, I think Sweden is always used as an example, where they actually closed too many branches and too many ATMs, and then actually almost had to start reopening them again because they saw all of these challenges. In the UK, I think it's there's another example where they have these groups now where they've realized that there isn't any bank branches within a sort of big distance from each other, and people that still want to be using bank services and cash are struggling, and they're starting to reopen these bank hubs where many banks kind of go together, and you would have one bank servicing each day of the week. So you still have access to your banking. It might not be as frequent as you're used to, but at least you have some way of accessing your bank physically as well. Okay,
Filip, thank you very much for your time. It's been a very, very interesting conversation. Thanks for joining us.
Likewise, thank you, Boris. Bye-bye.